Hi everyone, and welcome to our next panel, the evolution of the traditional medtech investor, what attracts capital in 2021. It gives me great pleasure to welcome the panel here today. As always, if you can make sure that you're asking questions, otherwise, they're not going to get answered, and interaction is always so much more important. So without further ado, I will hand you over to the moderator for the session, Tina. It's over to you.
Thanks, Becky. And hello, everyone, and thanks for joining us. I'm Tina Tan. I'm the executive editor of First Word Health Tech. And as Becky said, I'll be moderating this session. So if you've been listening into the earlier sessions this morning or even yesterday, hopefully you would have got some good insights from investors on the emerging trends and opportunities in digital health and in medtech, and where these markets are heading. So we know the pandemic has really pushed digital health to the forefront. Health tech companies are attracting a lot of attention. There's a lot of money clearly going to this space, but where does this leave all those startups with what I'd say more classic medtech innovations? Well, the good news is there is still money going into traditional medtech, and in this session, we'll be looking at recent investments our panelists have made in both digital health and in medtech. So why are we doing that? Those who have attended panels I've moderated in the past know I like attendees to leave with useful information they can apply to their business. And by taking a deeper dive into these investment deals, hear what it was about those startups that appealed to our panelists, whether you're a digital health company or a medtech company, and you're looking for funding, hopefully you'll be able to have some form of checklist by the end of the session, as to what investors are looking for. So those who also know me know that I like to make my panelists do most of the work. So I'm going to let them introduce themselves and give a brief overview of their fund. So why don't we start with you, Sascha?
Certainly, thanks, Tina. So I'm Sascha Alilovic. I'm a managing partner of SHS Capital, a fund based in Germany. We have been focusing for more than 25 years on investing into innovative healthcare companies, mainly from the German-speaking regions, but now also expanding into Nordics and Benelux, especially, with the most recent investments. We are a very flexible investor in terms of cash flow positive, cash flow negative companies, minorities, majorities, and across the whole life cycle of companies, from early venture to growth stages, and also to succession topics, buyouts.
Great, thanks for that, Sascha. Maybe over to you, Tamir.
Certainly. Hi, everybody. Tamir Miriam, based out of Israel. I'm part of the JJDC team, which is Johnson & Johnson's Development Corporation. We are essentially J&J's corporate venture arm. So we are investing in strategic areas to J&J across all of our three sectors, which are consumer, medical devices, and pharmaceuticals. I personally cover, together with my manager, Zev Zahavi, we cover Israel and medical devices and consumer in Europe as well.
Great, thanks, Tamir. And over to you, Daniel.
Good afternoon, Daniel Omani. I'm a partner with Strohmenger Life Sciences. I'm based in Dublin. We've offices in Dublin and Paris. We're currently investing from our third fund, so we invest in both the medtech sector and in the pharma biotech sector. And happy to have this panel discussion today. Thank you.
Great. And Fernando?
Hi, good afternoon, everyone. So Fernando Pacheco here with Endeavor Vision. We're based in both Geneva, Switzerland, and in Minneapolis, actually, as of quite recently. And we invest predominantly in medical devices, diagnostics, and digital health. Later stage, right? So generally in commercial stage companies within those sectors. So pleasure to meet everyone, and excited for the discussion.
Great. And last but not least, Rainer.
Good afternoon, everyone. My name is Rainer Strohmenger. I'm a managing partner at Wellington Partners based in Munich. We are investing out of our fifth fund generation, a fund that has a volume of 210 million euros. We have a European investment strategy with a certain focus also on the German-speaking part of Europe. And about half of what we do is in therapeutics. The other half is medical devices, diagnostics, and digital health. And personally, my background is in medicine and economics, and I've been with the group for 23 years.
Thanks a lot. So you can see that we've got a larger than a normal panel, and they're all well-established names within the medtech investing landscape. So as Becky had said, we welcome all your questions. This is your opportunity to ask, any of the investors or all investors, what they are, what they're looking for, or what they view, the trends to be. But I think, you should really take this time to really dig deeper. And as Daniel had promised us, apparently he's going to say something quite controversial. We'll see whether he delivers or not. But okay, so before we start, should we say, let's look at, let's first distinguish the different types of digital health solutions that are out there. I mean, it's a very broad area, and not all health techs are created equal. I'll pick on you first, Tamir, because you approach your investments from a slightly different angle to the other panelists. Be more of a corporate investor, I'd say, rather than an institutional investor. How do you slice and dice the digital health space?
So I think obviously you can't put essentially all companies in the same bucket, right? Digital health applies to be a very wide term in a sense. You look at therapeutics and diagnostics and monitoring and sort of more of a wellness app than anything else. I think there's a wide distinction that has to be made here. For us, I guess, we obviously seeing the big change in the market and the acceleration becoming much more aggressive than we had expected in 2020, obviously. And I think it's been an interesting thing to look at, but I think from us, given we are strategic, it hasn't really changed the picture because we sort of remain focused on a specific subset of areas. And for us, digital health was never necessarily an independent business unit, right? This has to support an existing product or an existing service or an existing procedure that we as J&J sell or provide to our customers or physicians. So there has to be some sort of a tie-in. That being said, with the advent of digital health really accelerating right now, we're seeing more and more companies that were, let's say, less mature before COVID and suddenly had, a growth spurt, if you will, and are suddenly becoming more relevant due to, gathering more data and having more collaboration from various institutions to do clinical trials nowadays rather than, before 2020. So we are seeing definitely on the deal flow side, more digital than we have seen, let's say 3 to 4 years ago. But from an investment perspective, I don't think that changed the picture so much for us.
And as you say, Tamir, and the pandemic has really sort of pushed digital health and what it can do for healthcare to the forefront of everyone's consciousness. And I wonder if that has shaped, just generally speaking, I wanted to provide some context before we drill down into specific investments. But do you think that because of the pandemic, it kind of shaped what are exciting areas in digital health? So telehealth, obviously, because there was that big demand for it, and then virtual, rather remote chronic care management. Maybe I could ask Daniel, what do you think?
Well, obviously, with the pandemic, there's been a renewed interest in digital health, telemedicine, remote patient monitoring, which is probably unprecedented, and that's understandably so, given that patients have difficulty accessing hospitals. Doctors have difficulty seeing patients, but disease development doesn't stop just because we have a pandemic. We still need smart ways by which clinicians and so forth can care for their patients. And when we look at the deal flow, which we've seen in the past 12 months, the explosion in deal flow in digital health and telehealth and remote patient monitoring is significant. And I think if you look at the attendees at this conference, both on the company side and on the investor side, I think it's true to say that there's a big increase in the level of interest in digital health investors and companies as well, all indicating or reflecting the fact that we have a pandemic. countries and people and organizations are taking unprecedented steps by which they can respond to it. And I think this is one of the very positive developments which has come from the pandemic, that it has forced us to leapfrog how we can provide medical care to people into the future. And that's been a benefit, if nothing else, from what we've lived through for the past 12 months.
But has this kind of provided you a guide with where, which areas within digital health to focus on in order to get the returns that you want to see?
I think in terms of focusing, so if you take patients with congestive heart failure, where the danger with those patients, they're back in hospital every 30 days or every 60 days. That's very difficult right now because there's a shortage of hospital beds, understandably so. So if you take the view that the pandemic and the tail end of the pandemic will be with us for quite some time, that would seem to me that for those patients who require chronic care like that there is a need for smarter and better ways by which these patients can be treated in the future. So certainly for those types of diseases, we see interest, we see opportunities, but equally so, we see opportunities in artificial intelligence, image analysis, being able to better diagnose, triage, and treat patients. So if you look at things like stroke, if you look at certain kind of cancers, we can see that those types of disease indications would benefit enormously from better digital health technologies into the future. So those types, they're certainly shaping our decision and our thought process as we look at opportunities in this space. Of course, it creates more competition, both in terms of funding, in terms of companies trying to develop something similar, which creates challenges for the investor in terms of, if we've got 4, 5, 10, 20 companies trying to develop similar product offerings, how do you differentiate one from the other? Are they really differentiated at a technological level at the end of the day? And then the question is, well, from an investment decision, you're maybe not investing in the technology, you're investing on a team which can execute on a business plan which will allow for maybe rapid commercialization and capture of good market share in their particular sector. So the decision-making process changes from the technological differentiation to the ability to execute and deliver on early commercialization and market capture. And I think that's where I would see is a key factor in the decision-making process for investors in this sector right now.
That's great. So I think that you set us up really nicely to move, into our deeper dives into, recent investments that each of you have made in, say, digital health. We start with digital health first, and what it was that appealed particularly about that investment. Maybe I see Fernando sort of like nodding very vigorously. Like, what very exciting investment have you made recently?
So nodding because I was agreeing with a lot of things that Daniel was saying, right? I think it's a good segue into that example, is that they still have to be fundamentally good businesses, right? The fact that there's been this big acceleration around digital health, a big trend, telemedicine, a lot of the reimbursement has been accelerated, doesn't mean that you don't have to target a fundamentally good business with good, fundamentals. And with the example I gave as a company we invested in, actually, interestingly, just before the pandemic, a company called IntelliCare. We invested in that company in January of 20. And what they're trying to do is being very, very focused on how they solve the staffing problem of nursing in post-acute care facilities in the US. And basically the problem is if a post-acute care facility, think a nursing home plus, something between a nursing home and what you get discharged from hospital, doesn't have the right staffing ratio or nurse to patient ratio, there's obviously a fall in care. And it's a difficult workforce. There's basically not enough people, right? And so what they did is effectively like an Uber, but around solving staffing gaps. And previously staffing, this is the power of what tech can do, right? Previously staffing was just done on an Excel spreadsheet on a mom and pop shop, calling people, hey, can you fill this shift, right? As opposed to something like this, which is done automated. And the reason I bring up the example is, yes, they developed a great platform and so on, but what makes it, I think, really differentiated is how focused the management team is on execution, in the sense of they really understand individual small markets that they go into, and you know, they're in only 8 states in the US and growing significantly. They understand the individual small markets they're going into to match the supply and demand of nurses versus hospitals, and do a great job there, and then go on to the next ones. And I think this kind of approach of being very deliberate with your businesses and making repeatable, systematic kind of growth around business models is something that sometimes we miss within digital health companies that come in and saying, hey, my app is great, everyone's going to buy it. You have to show which business model you're going to fundamentally use and be able to show how you can scale that. And I think that's an example of one that we saw that we're really, really happy with.
And that's interesting because, like you said, you invested in it just before COVID. Who knew, with the pandemic, that staffing issues became a massive problem. With like hospitals being overly burdened. I'm sure it's a very sad thing, but the whole pandemic. But I'm sure you're all high-fiving, saying this is like a great opportunity for.
Well, it was accelerated. Frankly, so COVID accelerated it, obviously. COVID hit these facilities particularly hard, right, as we know. But the other aspect of it is as well that there was a lot of stimulus for people to stay home, and including, people were getting a pretty good paycheck every week from the US government. And so actually, the differential for a nursing assistant, so these are often low-wage employees to work extra hours versus not work and stay home and get the paycheck from the stimulus program, wasn't that obvious sometimes, and putting themselves at risk. So yes, COVID accelerated things, but you would have expected it, absent that, to have accelerated it more.
Right. Okay.
So again, there's little nuances of these business models that are perhaps new or just, again, require ways of the company to then innovate. And okay, how are we going to approach this? Which of the micro markets we're going to go into that address that, right? Do we have to do our pricing differently? Do we have to do surge pricing? These types of things, right? I know they'll make us think of Ubers, which you don't use anymore, but some of that, again, good business fundamentals came in play.
Great. Thanks for the example, Fernando. Now, Sascha, over to you with the investment case study that you're going to present to us, one that you made recently and got you particularly excited. Following on from Fernando's point about business models, because with SHS, you've had a long history in medtech investing, and health tech is a different business model altogether. And sometimes it can be quite problematic for sort of like medtech investors to sort of understand the sort of business models. I mean, even health tech companies themselves don't quite understand the business model that would work. You can't apply what worked with medtech to health tech. Could you perhaps talk about the investment that you made within digital health and like how they presented a viable, good business model of their what they're offering?
Yeah, certainly. I mean, maybe I would phrase it slightly differently. I mean, we have, you're right. I mean, we have a long history of investing into medtech, diagnostic, and what have you businesses within healthcare. And we have maybe invested in some businesses which we today would call health tech or digital health businesses, which at the time were simply a diagnostic device using software algorithms at its core to analyze diagnostics. So now we would call it health tech. At the time, we just said it's a very innovative, disruptive diagnostic platform. So looking also at the business models, not sure, again, I mean, you have the same topics to be covered with innovative health tech companies. It's always about stakeholders, reimbursement, approvals as classical medical devices or algorithms in this case. So maybe one case we have invested into, which fits quite well, is Selfie, which is within the mental health space, helping depressive patients to actually do the consultation with a therapist online. So also some type of telemedicine therapy. therapy. We invested into them in January last year, so also just before the COVID crisis hit Germany and Europe. Our investment thesis at the time was actually that there's a very long queue for depressive patients to actually getting a therapy of their choice and treatment, therefore. And this really shortens the queue significantly. It makes it also way more efficiently to use online therapy, a combination of online tools and the real therapy consultation per video chat or video conference. And also in Germany, there has been, Germany is not necessarily known to be very innovative when it comes to new regulations in the medical fields, but we have a Digital Care Act, which came into effect, Q3, beginning of Q4 last year. And that was actually also our investment thesis that this will be one of the first companies to get an approval and reimbursement based on the Digital Care Act in Germany, which also took place end of last year. And now obviously also the market conditions changed a lot into the favor of that company, Self-OP. So yeah, we really see a big uptick and the confirmation of that investment thesis, really.
Yes, I know that. I have heard that reimbursement decision in Germany has been very, very helpful in terms of like creating yet a further surge, in another positive surge in activity around digital health investment. Now, Rainer, you're also in Germany, and which is why I'm moving over to you, really. Geographic proximity to Sascha. But actually, another thing, the reason why I wanted to come over to you now is because you had mentioned to me that one of your early investments was in digital health. You did move in this space quite early on, was in an electronic health record company in 2000. And now I imagine the climate then was very different, in terms of the quality, quantity of digital investments coming through the pipeline. And so, I mean, how do you, first of all, before you, bring your sort of like talk about your recent investment in digital health, maybe how do you think it's changed or evolved rather the digital health investment landscape then as it is now? Are investors like you, who are interested in like health tech in a better position?
Yeah, this is a very good question. And, during the last 20 years, I was involved in 5 digital health companies that we financed. And for me, the major trend is digitization, of any kind of industry. And what we observe is that the healthcare field is already relatively late to the game. And what you mentioned is that in the year 2000, we were already looking at opportunities in that field and came across a virtual electronic patient record company that, in contrast to everybody else, didn't store the data at one single location, but virtually compiled an electronic patient record on Java basis for the doctor, and that was extremely efficient and convenient. But it was, let's say, a little bit too early to the German market, and we then, found a way to merge that with an Italian company, floated it on the Milan Stock Exchange, and so brought it to a successful end. But that demonstrated that you can also be a little bit too early for that. And at that time, I think the overall perception of investors was you cannot make money in that field. And I know so many investors that had simply failed in healthcare IT, as we said at that time. And then later on, we in 2014 we invested in a Munich-based company called Definiens, which at that time already had emerged to become a technology leader in the field of digital pathology. So really using software to do just a much better diagnosis, and speed up the process in a very impressive way. By the way, we had looked at this company first time already in 1998. So it took us actually 15 years to invest in a company, and only 5 months later, the company was acquired by AstraZeneca via MedImmune, and in a very successful deal. And in the meantime, we have now also specifically looked for companies with a very special positioning in that field that already have some kind of market traction. And for example, one of our portfolio companies is called MBOS. MBOS in Germany already has a dominant market position as an e-learning tool for medical students and medical doctors. And for example, about more than 95% of all German medical students are using that for exam preparation. We have with all major universities, the company has agreements to equip any of their students with access to the system. Most recently, we did a deal with all universities in Portugal for our English-speaking version. New York University has licensed the system, and we are also moving now into the physician segment because practicing medicine means lifelong learning, and doctors require a very reliable source for information, and they cannot today. They are using Google and Wikipedia, and this is just not sustainable, and it's not controlled content. MBOS employs more than 200 medical doctors that are creating the content, and this is something that probably you can only start out of Germany, because the medical doctors in the US, they would simply be too expensive as employees, right? And that's why this company is also on track to gain a dominant position also in the US, and the English version is now used worldwide, and this company has a very high growth rate. And most recently, we also looked at the fields of digitization of therapeutic approaches. And one very interesting area has already been mentioned: mental health. Mental diseases can very effectively be approached with digital products. We don't think that the future is in just connecting therapists with patients. We think that you can really bring cognitive behavioral therapy, for example, on a smartphone app. And it's amazing how efficient that is in clinical studies. We have just recently spun off the former Alpha Health division from Telefonica, who have kind of pioneered that field for the last 4 or 5 years, and now have launched their first products. It's now called Coa Health. And they have a set of different products, from kind of an evidence-based well-being app through treatments that deliver cognitive behavioral therapy that the patient can use on himself. For example, for body dysmorphic disorder, where they have a pivotal study ongoing. And this is extremely exciting. And they also are developing and have just launched a tool that helps doctors managing their patients in a better way. And just to give you an example, if you look at the interaction between a doctor or a therapist and his patient, they might have an interaction every week or every 2 or 3 weeks. And in between, there is nothing. And a smartphone app can interact with the patient every day, every hour, as frequently as desired. And so it's no surprise that this has the potential to significantly enhance the therapeutic progress. And just to give another example, in body dysmorphic disorder, they have done a small first study where they showed that actually within a few weeks, 90% of all patients that used the platform got cured. So this is something that would be hard to achieve with classical CBT.
Right. So I can see quite a common thread there in terms of what appeals to you in these. I mean, you mentioned about health IT. It isn't health IT per se that isn't appealing, but you need to basically show that it has the ability to optimize a clinical workflow for the clinicians and for people within the healthcare ecosystem. So actually, because of constraints on time, I'd like to move on to the medtech side, because we do have quite a few attendees from the sort of the medtech market, which who are developing, technologies. I had previously called it classic medtech, but I don't know. I hope that doesn't offend people. But we're talking about those sort of devices or interventions. Not that they aren't high tech or incorporate some deep tech, but they aren't digitized smart implants that's designed to basically walk and crawl, and as I was joking to somebody, serve you a martini. Perhaps we can come back to Tamir, because I know J&J has a very diverse portfolio, and DePuy orthopedics, for example, is one area where there's well, it's hard to see some of the opportunities for sort of digital health around there. I mean, would you still be? You obviously would still be interested in investing in classic medtech. Where are the areas that you see the most innovation happening?
Yeah, so you're raising a good point, Tina. I think DePuy, as most of the folks know, we I think it was last week, announced the 510(k) clearance of our VELYS robot, which is the result of our investment into Orthotaxy and acquisition thereafter out of Grenoble in France. And I think there is a big move from essentially all the orthopedic players into robotics, which is a clear, clear change where most of the players were looking mainly at implants and sort of the various techniques. And I think the differentiation there nowadays between the various players is minute to, I'd say, almost non-existent between the quality of the implants. And where most of the players have to compete is sort of on the clinical outcome and the accuracy and sort of precision of the surgery itself, and sort of trying to level the playing field between the surgeons and their experience. So I think we're seeing a lot of play in robotics itself, and not just the $1 to $2 million robots where a lot of them are used as marketing tools rather than a clinical tool, but we're also seeing robotics that are used in, let's say, more niche markets or sometimes smaller markets, and spine and knee surgery. For example, we have our Israeli company OrthoSpin, which uses robotics and sort of smart robotics for external fixation, which is less than $1 billion market, but is a market that hasn't been disrupted in probably 40 years at this point. So they have taken, a simple robotic solution that is, I'd say, not to sort of discount the efforts and the work the team has done, which was incredible, but this is sort of a no-brainer that, external fixation is a market that hasn't been disrupted in maybe 50 or even a bit less years. So we are still seeing a lot of activity in the implants, sort of surgical techniques, miniaturization and 3D printing is definitely an area we are looking at, and others as well. So there are various verticals that are coming into orthopedics, for example, that are creating a big impact in that field. I think we'll have to see probably more smart tools, whether it's in navigation or imaging or pre-op planning, that will come into not just orthopedics and in general surgery as well. But we are seeing, even in, let's say, and excuse the language, the dumb devices.
Passive. I think passive is the word, the
passive,
PC word to say it.
Us Israelis tend to be blunt, so that's fine. So I'd say the dumb devices, in a sense, are also getting some smartness through pre-op planning and things like that are helping the surgeon get to a better clinical outcome. So for us, we're still obviously interested in the nuts and bolts and the implants and the new techniques and sort of 3D printing. But on the side, we're also seeing where can we impact the sort of the workflow in the OR and the patient journey from sort of getting into the physician and after the surgery as well.
Thanks for that, Tamir. And what about you, Daniel? Do you believe that, I'm sure you don't believe that medtech really is dead. Do you want to talk about recent sort of medtech investment you made and why you believe that there's a lot of opportunity still?
We are certainly of the view that medtech has a very vibrant future. Not all diseases can be treated through drugs or pharmaceutical intervention. That's the reality. There is quite a large number of diseases which will be best served through medical devices and through medtech interventions. And we see opportunities in a number of sectors over the next decade. Certainly, I think with implantable sensors for different types of indications, the Internet of medical devices is probably something in 10 years' time will be very, very a commonplace discussion. We certainly see opportunities there. Structural heart, the aortic valve is very well treated to date, but there's still huge unmet medical needs for mitral and tricuspid. So we see opportunities, but there's huge challenges there. In the areas of stroke, the success of first pass treatment, there are still opportunities and needs there. And there's a lot of developments with kind of thrombectomy approaches to increase the success with first pass treatments, but there's still unmet needs there today, we believe. We're an investor in Quanta along with Rayner in dialysis. It's a sector which is open for disruption. And I think, combining new home dialysis technologies with digital health and other types of approaches like that are approaches which we believe will be important in disrupting that particular sector of the market, which is a very large cost to healthcare systems at the end of the day. For us, medical devices has a very important role to play in the future for the simple reason that not all diseases can be treated through drugs. And it's really the question then of trying to understand what are those diseases, those indications which can best be served with, hardware which has kind of smart electronics on top of it as well, which allows for better interaction and engagement on an ongoing basis between the clinician and the patient and the healthcare providers in general.
Mm-hmm. Okay. Now, Sascha, rather than asking you about a particular medtech investment that you made recently, I'm interested to find out in terms of how you're obviously still interested in medtech, but how has the exit market sort of impacted, if at all, your decision on what areas of medtech to invest in? Because recently we've seen the biggest player, Medtronic. They made 7 tuck-in acquisitions. Almost all of them were related to some sort of digitization, and this year alone we've seen a flurry of deals around sort of remote chronic care, again related to this sort of future that we're heading towards a digitally connected healthcare system. How has the exit markets impacted the types of medtech investment that you're looking for, classic medtech investment?
Yeah, I would say,
Whoops, I think Sascha has frozen somehow. How
we see it actually. First of all, yeah.
Okay. Sorry, Sascha, we lost you there.
On my internet.
We lost most of your response. So do you mind repeating what you just said?
Sure. So I was just saying that that's a very good question. Typical question we ask early out in the process: who will be the acquirer of a certain asset, and why is it a must-have if it develops as planned for which specific acquirer? So for example, I mean, one case we just had, by the way, is a spin-off from Johnson & Johnson 3D printed spinal implants. So that's something which we see a potential future acquire already if we continue to develop it further. There, the exit route is super obvious. It's going to be a trade sale to one of those companies in the field. It's monolithic use, so to speak, very, very easy to see who the interested parties are. For digital health companies, that is not necessarily the case. You always have to really figure, and that's at least my perception, really figure out which of the acquirers today will be able to purchase this company in 4 or 5 years time down the road for a price that suits you and your investors. And that is way more difficult for many of the digital health companies to answer than in the classical medtech fields. If you look at the stock-listed medtech companies, they have all performed tremendously well in the last 12 to 18 months. And they also need to justify their valuations, in my perception, with new innovative products coming versus them to the markets. And that is not their core focus to innovate themselves most of the time, but rather to acquire innovation. And so, yeah, we see actually a lot of good opportunities in the classical passive medtech investment cases today.
Right. Can I just throw the same question over to Fernando, because I know you mentioned that about a good proportion, 70% or so of your portfolio is still within the classic medtech arena. I mean, how have you seen the exit markets, you know, for those investments?
So a couple of things. I think everything was on pause, right, for a good part of 2020. I think we've seen a big resurgence in the last few months. I mean, 2 weeks ago, there was 2 deals in the same exact space announced, one for I think in remote cardiac monitoring. You guys may have seen that, Preventus and Barty, right? It's coming back. I also think that some of the strategics are getting cut some slack and being allowed to, because they're getting cut slack on what numbers they put out there, they're being given more latitude from their own investors on what they can acquire right now, which was moving. Some of the acquisitions perhaps are moving a little bit earlier than they have been. It seems to be reversing the trend a bit than what it was in the past few years. But look, I think the exit environment is frankly quite healthy, right, across a number of different segments. I think one must, still be honest about oneself about what type of acquisition this could be for a company. It would be a tuck-in acquisition, right, in the $100 to $250 million range. Could it be a new business, would it justify a new business unit, right? Can this be a $100 million revenue company or a product line within a strategic? And obviously, Tamir, you can talk about that more than I can. But I think it's important to just be conscious of those things. The exits are coming. I think what we've seen, and we have to mention it, what's happened with medtech in particular over the past couple of years, beyond the exit environment being healthy from an M&A perspective, is the IPO market, right? The IPO market in medtech has been incredible over the past couple of years for specific assets with really big markets, with really differentiated technology, with really good clinical data. And it's good to see. On the one hand, it's good to see that as a medtech investor, because you hope your portfolio companies can be part of that and benefit from that. On the other hand, it's also given companies a lot more options, right? And so I think that alone has been responsible for driving up valuation more than what's happening with the M&A environment, right? But I'd say it's quite healthy, and I think it probably will continue on the M&A side and probably on the IPO side for at least 6 to 12 months, and then let's see.
That's true. We have seen quite a few traditional IPOs as opposed to SPACs, because the SPAC route seems to have gone completely crazy. But there are still a very healthy sort of flow of traditional IPOs. And like you say, that should like provide some positivity to companies looking to exit there. We're running out of time. In fact, I'm running over time, and I'm about to get a virtual wrist slap on my wrist. So there have been some questions. This will have to be very quick, because I do want the attendees to be able to, hear what the panelists have to say. But this is an interesting one, and it's a bit specific, but it says it's about electronic medical records. And I guess it's saying that on that side of things, in terms of digital health, the question is, what will force doctors to go digital? I suppose we could expand this question, not just to electronic health records, but the clinical adoption. Obviously, we need buy-in from the doctors. Is this considered like a barrier still? Or do you think because of the pandemic, has this really, there's no turning back? The clinicians can understand that there is a need to be more open towards health tech. I'm going to have to be school momish about this and be strict, and I can only give one panelist say in this. Who wants to answer this question? Raise your hand. I'll let Rainer speak.
Yeah, I can, maybe I can briefly comment on that. I think we need to be aware that every doctor has a business model himself, so reimbursement structures drive this. And in the past, that has not always been the case, that the reimbursement environment was really supportive for use of digital products, digital infrastructure. And we've seen a very important step in Germany, in that direction, with reimbursement for digital therapeutics or digital diagnostics. Of course, COVID has further accelerated that. And now I think the change in paradigm is that doctors also made the experience that this is more efficient, that this is more convenient for them. They can be more efficacious, and they will increase the pressure also on the reimbursement framework, to further pay for products that actually make sense for their work and for the patients. That's my belief. So I think we are now in a different situation than we were 10 to 20 years ago.
Mm-hmm. Well, thanks for that. I hope that answers the question for the attendee who posted it, although I did embellish on your question a bit. Unfortunately, we're really running out of time now. And to wrap things up, I had said at the start that hopefully those listening in will be able to create sort of checklist that could help them get investment. So to conclude, I'd like each panelist to say, what is the one most important thing startups should do, regardless of whether they are in classic medical device or digital health? What is it that would make you put your money on the table? Maybe let's start with Sascha.
Yeah, I think it's very similar to what also Rainer just said. It echoes a bit his statement. Thinking about not only the improvements of the system or whatever it is, benefits to patients, but also all the stakeholders and how to convince the stakeholders, all of the relevant stakeholders in the system. That is something not done often enough and super important.
Great.
Just one sentence.
Thank you. That's really helpful, actually. And Daniel?
My advice for startup is to get as much free advice as they can initially from expert, be it clinicians or engineers or industry people, and to try and take that advice from diverse sources, hopefully advice that will contradict each other in some regards, and to use that to build your business case, because it's very easy for somebody to fall in love with an idea and a technology, but you got to really critique it and challenge it before the horse kind of leaves the stable, so to speak. So that would be my advice.
Great. Tamir?
Yeah, I'll try and be short in following Daniel's advice is, be sensitive to the valuation you're thinking about, because I've seen crazy valuations in the market that simply don't justify, especially in COVID days. and maybe plan for a bit of a longer runway than you had expected, especially due to the uncertainty of COVID.
Great. And Rainer?
Yeah, it's hard to add something that really makes sense, but I would also add that, you know, you should really take the view of all the market participants whom you need in order to make your business model, your product successful, being it from a regulatory point of view, being it from a reimbursement point of view. It needs to be accepted by the doctors. It needs to help the patients. And then, of course, it also needs to represent a very good business model. You need to have sufficient margins, and you also need to have, of course, IP protection. So you actually need your company to tick all of these boxes, and then, you know, you will receive financing.
Great. And I'll let Fernando have the last word.
Big responsibility. Two quick things. One, take the clinical high road. It will pay off. Go for the PMA instead of the 510K, that type of mentality. It will pay off. You'll reap the benefits in terms of barrier to entry. And then the second thing is just be conservative on your market size estimates and be really targeted on what those are from the beginning, because that will help you focus as you navigate the multi-year process that it is to get there.
Excellent. Well, that just leaves me to thank all our panelists for their wonderful contribution today, and to you, the attendees, for taking the time to listen to us. And I'll now hand the virtual reins back to Becky.
Thanks, Tina, and thank you to all of the panelists for their great insights. You know, sometimes we do have to run over a little bit, but it was worth it. So, you know, thank you for taking the time and answering the questions. So our next session is in a mere 5 minutes, where we'll be delving into the world of China's booming medtech market. And I'll actually be joined by Tina again in just an hour for our interview with Glenn Tullman-Luongo. So until then, I'll see you on the other side, but I look forward to seeing you back shortly. Many thanks.